Hello, and welcome to Chapter 22 homework, Statement of Cash Flows. Got a couple exercises here in Pearson. Well, actually, there's 6, but the last 4, I've got a PDF out there with the solution that we will work through. I think that will be more effective than trying to work this on the screen and with the notepad. It's just too much to try to go through. In this environment. All right, so let me share the homework. Hopefully you can see that. Here's exercise 1. Again, we'll look at the first 2 on here, then we're going to get out of Pearson and go to the PDF that I have put out there under the D2L content under, I believe it's exercises. All right, so this first one is just a question of where do you put each of these items on your statement of cash flow. Is it operating, is it investing, is it financing, or is it something that's a non-cash disclosure? You can see the answers there. I don't know if I really need to belabor the point on this, but you always want to look at the title there for what's the account title that I'm impacting. Cash payments to suppliers and employees. That sounds like your ongoing business, right? Accounts payable. Wages payable, that's got to be operating. Those are current liabilities. Cash payments for principal on debt. Sounds like finance because that's a long-term liability, isn't it? Yes. Cash receipts from customers. Sounds like accounts receivable, so that's got to be operating. Cash payments for PP&E, that's an investment, long-term asset. Remember the chart? Long-term asset. Investing, the dark green shade on the PowerPoint. Cash receipts from sale of securities, long-term asset. Cash receipts from interest, sounds like operating expense, interest payable. Cash receipts from issuing equity to owners, financing. Cash payments of and for interest, again, operating. I guess that was interest receivable. I said interest payable. That's interest payable. Cash receipts from the sale of property, plant, and equipment, investing. If there are gains or losses, you would have that also in operating as well, right? Payment of dividends, financing, because that's related to retained earnings. All right, and cash receipts of dividends from investments, operating. All right, very straightforward. Number 2, state whether a firm would add or subtract, because once you find out if it goes in operating, investing, and financing, the question is it a positive or a negative? So an increase in a prepaid expense. Asset goes up, so that has to be subtracted from cash. Decrease in income tax payable, subtracted. You're making payments against your payables. Decrease in accounts receivable, that's a plus. Increase in inventory, that's a negative. Decrease in the current portion of long-term debt. Decrease in the current portion of long-term debt. All right, not in operating activities. I'm not sure what they're referring to there. As they're saying, they're just reclassifying from long-term to short-term, which is a non-cash item. And accounts payable goes up, that's got to be a plus to cash. All right, so these others that you'll work on your own, we're going to get out of Pearson and pull up this spreadsheet that I've got, not spreadsheet, PDF that I have. I hope you can see this. But the solution is what I'm showing first. And this is exercise 3 of 6. You know, there's 6 of those. We just did the first 2. So this is 3 of 6. All right, so what are we going to do here? Because this is the solution. We're probably going to go over here and do what? You should always start with your income statement, which is the 3rd page. So there's my income statement. And I've got it highlighted in yellow there, what you're looking for. Which starts at the bottom, right? Net loss, $448,430. So that's going to be the first entry that we make on our statement of cash flows. Doing the operating section, you want to add back all your non-cash items. There it is, bad debt expense. Because what is bad debt expense? That's where you debited bad debt expense and credited allowance for doubtful accounts. So it's a non-cash item. We got to add it back. Add back depreciation, add back amortization expense. All right. So let's go back up here to the top, since we've got that done. And there you see my $448,430. I've added back depreciation, I've added back amortization, and I've added back bad debt expense. Now, the one we didn't talk about here is this increase in deferred tax asset. That is a non-cash item, and they choose in Pearson to put that here in the operating section. I guess you just need to remember that's where Pearson likes to see it when you work these exercises. Well, how do we know it's $220,000? Because there's nothing on your income statement there, right? So where's that going to be? It's going to be on your balance sheet, and that's what you see there. $220,000. Current year, $220,000. Last year it was $0. So this is an asset that has what? It has gone up. You debited deferred tax asset. So it's just like any asset. Any asset that goes up is a what? A negative to cash. So we got to take that $220,000 off of there and put it right there as a negative. All right, so now we are done with the income statement. Everything else in this sheet is all about the balance sheets. One balance sheet from one year versus the current year. What changed there? And what's unique about this is, and you see my notes here, is that bad debt expense. When we start going down through here and looking at like accounts receivable, what is the difference? Accounts receivable, where is it? We don't do anything with cash. That's what we're trying to explain. Why did cash change? Accounts receivable was the first one. $200,600, $189,770. How much is that? Because that says what? My accounts receivable went up, didn't it? $200,600 minus $189,770. That's $10,830. Well, I just don't put $10,830 over there and change in accounts receivable. Why? Where's the bad debt expense come from? All right, that's a reduction of retained earnings. That's a reduction of accounts receivable. So look right here at this T account that I've got there for you. There's my beginning balance, $189,770, right? There's my ending balance, $200,600. So there's my beginning, there's my ending balance. All right, what's this 66.3? That's my bad debt expense. That's on my income statement. So how do I know it's a credit for 66.3? In reality, it should be out here in another T account called allowance for doubtful accounts, shouldn't it? With a credit balance of 66.3. I just make it simpler by not having a separate T account for the allowance and just put that credit there. So that is my beginning balance. I've reduced it by $66,300 for the allowance for bad debt expense. If that's my ending balance, then to true this up, I've got to make an entry for $77,130. But I'm not making the entry, it's already been made. And so that says what has happened. My accounts receivable has increased by $77,130. All right, so what does that look like on my statement of cash flows? $77,130. Accounts receivable went up, it's got to be a negative. Any asset that goes up, it's a negative. But look at my little notes there. See, I've drawn that total. $66,300 minus $77,130 is a net negative of $10,830, which is what we just calculated. Right? We just calculated that. So that's what you've got to do. This is the change in the book value, $10,830, but you've got to explain what is in the $10,830. What part was bad debt expense? What part is your actual accounts receivable went up or down? In this case, it went up. All right, the inventory is a little bit easier. Let's go down there and look at that. Merchandise inventory went from $380,000 up to $453,000. So that is an asset that's gone up, and that's what, $73,000. So that $73,000, since my asset went up, it's going to be a negative. All right, what about accounts payable? Accounts payable. Accounts payable went from $196 up to $386,840. So that's an increase of $190,840. If your liability went up, that's a what? That is a positive, right? You're not paying your bills, are you? Which means you're holding on to cash. Decrease in taxes payable, 85,000. It was, prior year was 85, now our balance is 0. So we had to pay off that income tax payable with cash, didn't we? So that's going to be a negative for 85,000. All right. We skipped this current portion of long-term debt for now because Pearson likes to include that down here with the other long-term note payable. That's fine. All right. So what's next? All right, we're done with the operating side, aren't we? So my net cash provided by operations is $358,420. Start with my loss at all these changes, $358,420. All right, what's next? Equipment. And I'm going to do the same thing with this equipment that I did with this accounts receivable. The same algorithm. What goes through your mind when you're working this. 624,000 is the change in my property, plant, and equipment year over year. That's how much it went up. There it is. 1570 to 2194 is 624,000. I've got to explain that 624,000. But part of that is what? Depreciation expense. So depreciation was 250, right? And there's my property, plant, and equipment using a T account. I'll start with 1570. See that? There's my ending balance, 2194. I know I have depreciation of 250. Again, you think, why you got 250 as a credit to PP&E? The same thing if I had accumulated depreciation in a separate T account. I just merged the two together to make it simpler, right? So I know it's been reduced by 250. And so now to get to 2194, then I must have made purchases of 874,000, right? Yes. So that 874 has to be recorded on my books right there. And then when I net that against the 250 up here, there's the change in book value, 624, change in book value. Okay, what about this next one? Purchase franchise. It's another long-term asset. Long-term assets are investing. Went from 99,170 up to 177,370. Again, there's my T account. 99,170 ends up at 177,370. What's the 38,000? Amortization expense. All right, so if I've reduced that by amortization, then the difference in this total and 177,370 is 116,200. So I must have purchased intangibles for 116,200. So we plug that in. There it is, 116,200. So now we've completed the investing section, and the net cash provided by investing, $990,200. Okay, so that leaves the financing section. Again, that current portion of long-term debt, which you think, well, should that have been up there in the operating section? I don't know. Pearson wants you to put it down here with financing, since it's a part of that. This is the current portion of this. So this $24,200 increase in long-term debt is going to be added in down here to this $201,195 difference in these two. So the net increase in long-term debt is a plus of $225,395. My debt has gone up. Any liability that goes up is a plus to cash. So $225,395 is going to be put right there, right? The plus group short-term and long-term. That's what that says. Group short-term and long-term together. And then treasury stock. That's the next one. Because those two have been handled. That's done. Common stock, additional paid-in capital. So how does common stock go from 609,065 to 969,625? Well, I meant to do treasury stock first. There's treasury stock. We'll come back to that. Treasury stock goes from 348,735, that's a debit balance, to a debit balance of 787. So that is what? That's a reduction of equity. All right, so that's got to be a negative. Think about it. You're buying treasury stock. How do you buy treasury stock? Through cash. So there's my 438,415. And then this part about common stock and paid in capital, adding those two together, looks like you sold some stock, didn't you? Well, you sell stock, you what? You actually have an increase in cash of 1,584,560. All right. And there it is, 1,584,560. Treasury stock, all right. About retained earnings. What do you do with retained earnings? Let's go over to the notepad and work that. Now we're going to do this here in a minute on something else, but we need to do it here as well. You always need to make sure retained earnings is reconciled. It's not a big deal. You just want to make sure all your dividends are taken care of. So if your beginning balance of retained earnings is 658, 820, and it says the ending balance is 210, 390, and my net income was how much? 448, 430. Retained earnings started with 658, 820. That's beginning balance on my ledger, and the ending balance is 210, 390. The only thing that happened, because it doesn't mention anything about dividends, but this, by reconciling retained earnings, will tell you if there were any dividends that you would need to put on your statement of cash flows. It says our loss, right, and the loss is a debit, was 448, 430. And so if we take this minus this, that should give us 210, 390. And it looks like it does. So there are no dividends. That's the way you check on something like that. No dividends. All right. So that is, didn't mean to do that. That is problem 3 of 6. 3 more to go. Again, this entire document is out there on D2L for you to look at, print out, and study. Again, these are just T accounts, how I work it, to make sure I know everything that's going on. You don't have to worry about that part of these exercises. I probably should have just left that off. So let's look at number 4. Moving right along. Again, we want to start. Of course, I've got the solution first. And we want to go down here to the income statement. So I'll just pass it. Now, there it is. You always start with the income statement because that's the first thing on statement of cash flows is your operating. So start with net income, 119,650. There's depreciation expense, and there's bad debt expense. It's the same process that we did in that prior example. So there's my 119,650. There's depreciation. There's my bad debt expense. But look, here's a stock-based compensation expense. All right, but that's not on this income statement, is it? That is probably buried somewhere in SG&A. So how did I know stock-based compensation should go there? Like the deferred tax asset on the other problem. Well, that's where you look at your balance sheet. Look at your balance sheet. Look down here under equity, deferred compensation. It was 37.5, which means that was a debit balance. That was a debit balance of 37.5, and during the year that would have been credited with a debit to what? Stock compensation expense. So we know we've got 37.5 somewhere buried in this income statement right there. It's part of this 83,200. See, like you have to be a detective. So there's my stock-based compensation, 37.5, non-cash item. Got to add that back because this is accrual basis of accounting. We're adding back all these non-cash items. See, we're changing from the accrual basis back to the cash basis. That's what statement of cash flows does. Okay, what about accounts receivable? Because now we're just going to go down the list here. Same process. Start with 27,200. My ending balance is 24,009. There's my bad debt expense. So I must have had a what? $6,000 net. What is that? 83 from that. That doesn't look right. I guess it is. $6,000 net increase in accounts receivable. Oh, well, I got a negative net increase. So that $6,000 up here, it's plugged in because I got a net increase in accounts receivable. So the 6,000, and I don't have the errors on this one, 6,000 and the 8,300, what is that, a net $2,300? Right? If I went from 27.2 to 24.9, it's $2,700, right? Down. But again, you got 8,300 from writing your asset or accounts receivable down, and you got 6,000 of it going up, right? So there's more down than there is up. But you got to make sure the difference in this and accounts receivable, 8,300, 6,000, you got a net increase of $2,300, don't you? Net increase of $2,300 because you have a net decrease in your accounts receivable. Net decrease of $2,300. You have to think about it, right? Net decrease, 2,300 down. All right, merchandise inventory, 9,900. Prepaid expenses, 99. You don't have to do anything there except plug in the 9,900s. Increase in accounts payable, increase in taxes payable. I don't think there's anything challenging there. Accounts payable, income tax payable. What about this dividends payable? Now, this is unique. Dividends payable. You think, well, I'm just going to put what? 22,400. Dividends payable went up, so that should be a positive, but it's not. Think about what you're doing. If you started with zero, and there's my T account. If you start with zero, right, and you end up the year at 22,400, you got to be careful. That's where you got to reconcile retained earnings. You can see I made a mistake and had to go back and change that since I did it in pen, didn't have any white out. But look what happens there. Reconciling retained earnings like we just did on the other one. There's my beginning retained earnings, 499.5. There's the ending balance at 555,400, which I don't know why I've had it on the left side. It should be right there. Should be a credit balance. All right. My net income was 119,650. The 119,650 net income. So 499,500 plus 119,650. If you add those two numbers together and then subtract that from 555,400, again, that should be right here, not on the credit balance or debit balance. It should be a credit balance. Then that says I should have a debit to retain earnings of, what is that, 63,750. That's my plug number. Well, the only thing that can be is dividends. There's not a lot goes on in retained earnings. There's no prior period adjustments or anything going on here. This is just, if it's not net income or loss, it's dividends that impacts retained earnings. So 63,750 would have been the reduction of retained earnings, a debit to retained earnings, and a credit to 63,750 dividends payable. So that's where, again, I was off a little bit. That's why I've got that marked out, not 64. It should be 63,750. So if that was 63,750, how do I get to 22,400? 41,350 must have been paid out of dividends payable, and that's what's relevant. 41,350. Got to be careful. all days. Wherever it is, there it is. Cash dividends paid, 41,350. You don't have dividends payable up here. You don't care about that. It's being reconciled down here through what was paid. You can't just look at dividends payable. Dividends paid. Again, dividends come out of retained earnings. It's not the dividends payable. It's not a current, it is a current liability, but it's not in the sense that it's going to be up here. It's going to be down here under dividends paid. All right, that's what's unique about this exercise is you had to reconcile accounts receivable, or excuse me, retained earnings. We had to do accounts receivable as well, but retained earnings. All right, what else is going on here? Notes payable went down. So if notes payable went down, that's going to be a negative for cash, the difference. And then down here, common stock and additional paid-in capital, that was a net increase of 341. So anytime a liability or an equity account goes up, that's a plus to cash, 341, 420. All right, so that should be it. Yep, 346, 41, 350 we just did, and there's the stock. Did I skip the land side of it and intangibles? I may have. Land, nothing changed with property, plant, and equipment, did it? Accumulated depreciation, that's already been plugged in. And there I have intangibles. So intangibles went from 22,007 to 0. So that's got to be a plus for intangibles, doesn't it? Yep, there it is. Each one of these exercises has something unique. Exercise 3 is about deferred tax and, of course, learning how to reconcile bad debt expense and accounts receivable. And your property, plant, and equipment along with depreciation. This one was about stock-based compensation, how you find that, but also reconciling your retained earnings to find out what your true impact on your dividends payable was. It gets a little more complicated out of principles once you get into intermediate and beyond. All right, so that brings us up to number 5, which is another exercise. They're reconciling retained earnings again. I don't know what's unique about this one. There's my income statement down at the bottom. Start with 263,051 on our statement. We add back bad debt expense. We add back depreciation expense. Oh, this one is a gain-loss problem. That's what's unique about it. Much like what we did in the PowerPoint exercise. So we've got a loss of 50,004. So if you have a loss, you add it back. Right, you add it back. All right, so 50,004. So let's go back up here to the top. There's my net income. There's my depreciation. There's my loss added back. There's my bad debt expense. Increase in accounts receivable. Again, we got to do the same thing we did. And I don't think I have that actually shown here as the accounts receivable. No, there it is. Go on the balance sheet. There's my beginning accounts receivable. There's the bad debt expense. There's my ending balance. 17,023 is my net impact. So when you add those two together, that's the difference. But you're breaking that out, this difference out, you're breaking that out into 2 areas. All right, there's merchandise inventory, there's prepaid expenses. What about property, plant, and equipment? Those 2 numbers. Because we had a sale, didn't we? There's my beginning balance. Somewhere, there it is. 43,22,974. There's my ending balance. There's my 39,524, which is my depreciation expense. So the balance is 429,400 change. Right? 429,400. So this $50,004 loss, that plus my equipment here, that has to equal to the change. $429,400. Retained earnings, we need to reconcile to get the cash dividends paid. See how you take the beginning retained earnings balance, your ending balance. There's my net income. So that's got to be a debit for $59,054, which says those are the dividends paid. All right, so that's number 5. Let's go ahead and look at 6. I won't belabor all those points over and over again. Pretty standard. So the final one here is, look at our income statement. That's where you always start. $46,800 loss. Bad debt expense, loss on sale of investment. So here's another one with a loss. Add back losses, right? Subtract gains. 46,800. Back up here to the top, there's my $46,800 loss. Add back the loss, there's my bad debt expense. Again, I'm showing that relationship. Those two together have to mirror the $455,800 change in book value for my accounts receivable. Right there, 524 to 979.8. There's my 18. So that must be 473.8 to make this thing balance. There's my investment, $299. My investment went from $299 to 0. But we had a loss, didn't we? $299, there's my loss, $41.9. And so I must have $257.1. But again, remember, make sure these balances like this, $41.9 and $257.1, is equal to the change year over year on your balance sheet. That's the gut check. Same way we do with accounts receivable. 455.8 is the change in book value for accounts receivable. You're just breaking this out for users of these financial statements to understand what's taking place with your cash. And again, always reconcile retained earnings. Beginning balance, ending balance. 46.2 or 46,800, that's my loss. And so I had cash dividends paid out of 187.7. There's no other explanation for it. Has to be. All right. So those are the 4 exercises. Make sure you understand those so you can work them on an exam. And that is chapter 22, getting quicker and quicker. These last couple of chapters, 21 and 22, are a little bit more succinct anyway, or don't have as much material as some of the other chapters do, so that's a good thing. All right, I hope you learned something from these videos. Spent a lot of time taping these. I guess I'm taping, videoing, recording these, so I hope you have a good day. And if you have any questions, please email me, and I'll be glad to probably try to group the questions together if there's several and just answering one to everyone, because usually if someone asks a question, there's others wanting to ask a question. But I will get back with you just as soon as possible.